Hi, welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Tadas Viskanta. Tadas is the founder and editor of Abnormal Returns. He's a private investor with over 25 years of experience in the financial markets and the co-author of over a dozen investment-related papers that have appeared in financial journals. Today we're going to be discussing his book, Abnormal Returns, Winning Strategies from the Frontlines of the Investment Blogosphere. Tadas is a name brand in the blogging world, so let's ask him 5 good questions. Welcome back to the show, everybody. My guest today is Tadas Viskanta, author of Abnormal Returns. Hey, Tadas, thank you so much for taking the time to chat with us today.
Hey, Jake, it's my pleasure.
It's kind of fun to have somebody on that's in the blogging community that has such a strong presence there, because I think it's a little bit different than a lot of the other authors that we have on.
Well, it certainly is a different world, but I think there's certainly some crossover there between the blogging world and kind of the longer form content. So, but it's great to be on.
Let's jump right into it. So, question number one, obviously you have to process a ton of information when you're putting your blog together and your book and us as investors in general. In this world today, I mean, there's an information overload. How do you go about not getting overwhelmed and making sure that you're really sort of separating out the signal from the noise?
Well, that's an ongoing challenge. I mean, it's a challenge for me, and like you said, it's a challenge for everybody who is an investor or really anybody who's kind of interested in the broader world. So I think it is an ongoing challenge, and I have to say that there's really no easy or simple solution. So I think the most important thing is that you kind of align your time frame and your interests to the level of kind of the media that you're reading. The vast majority of investors really should be long-term investors, and they really should have their eye kind of on the long-term ball. And so, the day-to-day and even the week-to-week and even the month-to-month kind of zigzags in the market really aren't that important to them. I mean, they really should be focused on kind of the longer-term sort of ideas and kind of the broader trends that are really going to affect them over the long term. Obviously somebody who's a short-term trader needs to be aware of what's going on, day to day and minute to minute. So I think there's kind of a really broad spectrum of media out there, and I think you really have to tailor your reading to that. And so, for somebody like me, I'm really, my idea is I'm really looking at stuff that I find interesting, and I'm looking at stuff that's going to hold up over a couple of days or even week or even month-long sort of term. So I'm looking at commentary, I'm looking at analysis. I'm really not looking at the news per se. So from my perspective, I've got a little bit longer time perspective than the newspaper, but shorter than a book or a magazine, something along those terms. So,
and kind of following on with that question, that fits in it seems like the world is also becoming more complex. Pretty quickly. And if you look specifically at like the evolution of ETFs, let's say, how it started off as sort of one idea, and now it's like, it's almost like a Cambrian explosion in the ETF world.
Yeah.
How do we work against all of this complexity that we see?
Well, I think, there's only, like you said, the world becomes increasingly complex, whether we like it or not. And I think it kind of goes back to to the earlier question. You really have to focus in on what's important and what really matters to you. And so, like you said, it's really easy to get distracted by all sorts of trivia and minutia. And, I think a lot of the social media out there is really just out there to try and lure you away from the things that are really kind of important. So again, kind of focusing in on what's important to you and what will really affect your life, I think is kind of the key. And so again, as we kind of get more specific about investing, about ETFs, like you said, we've gone from essentially one ETF all the way up to thousands of ETFs, and you've gone from broad asset coverage to very highly specialized sorts of ETFs. So again, it kind of really, your perspective should be a function of your time horizon and your strategy. And so for some people, those thousands of funds matter, but for someone who's following a really simple strategy, all that matters is really kind of a handful of funds. And so it's relatively easy to sort through that sort of those sorts of funds and from that sort of perspective. So again, you can't look at everything. It's easy to be distracted, but again, kind of focusing on your strategy and focusing on your own needs is important. And I think that's why I think I've talked about it in the book. The book's a few years old, but it's really important for you to kind of think about, have write down your strategy and how it is that you're going to go about investing your portfolio and use that as kind of a guidepost. And, you don't have to revisit that very often, maybe once a year, maybe every couple of years. That should really guide how it is that you go out, searching for and processing information.
Yeah, that makes a lot of sense. And then I think letting go of that fear of missing out is one of the keys to not getting sucked into the vortex.
Oh yeah, and the financial media. I mean, that's really what it's driven by. I mean, it's not a mistake that CNBC has a crawl at the bottom of their screen, which shows you, kind of the biggest movers. I mean, that's to grab your attention. That's to say, hey, why is XYZ up 10% today? I mean,
How'd I miss that?
How'd I miss it? Stay tuned for the answer. And so, that's what it's there for. I mean, it's there to distract you. It's there to keep you tuned into the show. So
yeah, exactly. So question number 2, shifting gears a little bit. Seems like over time, as the economy has transitioned from more like property, plant, and equipment being a specialization for a business and a real like defining factor, to more information led technologies. Accounting does a pretty good job of keeping track of property, plant, and equipment, depreciating it over years.
right.
It's maybe not so good at intellectual property.
Mm-hmm.
So given the idea that maybe the accounting in the last, has sort of deviated from maybe economic reality because of this new phenomena, is it possible that a quantitative driven approach may also not work as well because it's harder to value the business basically and just purely going by the numbers in the accounting?
Well, I think there's two separate questions in there, and I think one for sure, you're absolutely right, is that the world has changed and business has changed, and we have moved, like you said, we've moved away from where depreciation schedules really matter to a world where we're talking about where businesses are built on the cloud. PP&E becomes a whole lot less interesting, a whole lot less relevant. And so you're absolutely right in that perspective. And it's going to take a while for accounting to kind of catch up to that. But the second part of the question is really about investing. And I think from that perspective, again, you can't stand still. Obviously, I just was reading something this week talking about how kind of historically people have used price to book as kind of a valuation indicator. And it's really kind of stopped working. And I think that's in part because what you're exactly talking about there, book value is becoming less relevant as a valid measure of value, as it were. And so I think from that perspective, you obviously, no quantitative strategy can stay put. And so it has to, like you said, it does have to change with the times. But if a strategy like that doesn't work, then I think there's a bigger problem in terms of what it is we're talking about with the market. So I think a quantitative strategy that is well designed and up to date should continue to work. But one that was built 20 years ago in a different economy with different sorts of standards probably won't continue to work. So I think, like you said, I think you're absolutely right. The world is changing. Accounting needs to catch up to it. But a quantitative strategy, an investment strategy, has to keep up as well.
Yeah, I think I saw that exact same report that you saw. I think it was from Patrick O'Shaughnessy.
Mm-hmm.
And my working hypothesis, was that I know a lot of cheap companies that screen well on price to book a lot of times have a lot of debt as well.
Right.
So I couldn't help but wonder if perhaps, as you start to reach the end of a debt cycle, that a lot of times those companies are going to get trashed harder than the other companies. But that was why it's lagged so many other valuation metrics or value metrics.
No, I think you're going to have more examples of Amazon. And, I don't know whether Amazon is cheap, expensive, or fairly valued at this level.
Yeah.
But it's traded at this kind of level for a really long time. And so either the measures we're using to say whether it's cheap or expensive are wrong, or it's just or the markets are completely irrational, and Amazon is, has been wholly misvalued over, for a decade. And so I would lean towards the idea that Amazon is probably relatively fairly valued. And so the measures by which we're saying it's cheap or expensive are probably either outdated or off the mark.
Yeah, just maybe not quite as applicable.
Right.
Okay, so question number 3. I've heard a lot of great investors say, I don't compare myself to, or I shouldn't compare myself to the S&P 500. And yet, pretty much everybody does. I mean, it's just this huge benchmark that is pretty much ubiquitous. What do you personally use for your benchmark, and what do you think about benchmarking?
Well, benchmarking is obviously important. I mean, I think anybody who is in the markets, or especially one who is trying to generate some alpha, has to use some sort of benchmarks by which they can measure their performance for themselves and for others.
Yeah.
So obviously, benchmarks are important. And so a couple of things. If you're a large cap domestic equity manager, then the S&P 500 is a perfectly fine benchmark. Where it goes wrong, I think, is in a couple of ways. One is we live in a global world. So looking just at domestic equities doesn't, is missing a big part of the picture. And the other part of the picture is that there are other asset classes out there, debt, real estate, private equity, venture capital, all out there as well. And so again, we're just getting, the S&P 500 just one small slice of one market. And so I think taking kind of a holistic sort of approach when looking at performance, I think is important. So, but I think that, again, this is kind of a media phenomenon where we compare the performance of a hedge fund against the S&P 500, and again, that may or may not be relevant. It really depends on the underlying strategy of the hedge fund.
Yeah.
And so, again, I think it's in part a media phenomenon, and it's part just because it's easy,
Yeah.
to have one single measure. And if there were some sort of recognized kind of global multi-asset sort of benchmark, I think that might be the solution. But I don't expect that to gain traction anytime soon.
Yeah. So what would you use, like, let's say for global equities then? The Morgan Stanley.
Yeah, no, I think any of those that are that capture a large percentage of the market cap, whether it be MSCI or
Yeah.
whether it be the FT indices, I think any of those will get you most of the way there, and so that's all you really need. But I think again, talking about papers that we read this week, there was a paper talking about using when testing strategies, using random. Kind of random portfolios, and I think that's an interesting idea as well, especially when you're talking about a stock selection strategy. I think that's interesting where you take away some of the issues involved with market cap, and you're really just kind of looking at a random portfolio. So I think that's interesting as well. That's a little bit more technical, and that's probably for somebody who's following a strategy like that. But anybody who's investing for kind of over the long term and is using kind of broad-based asset classes, I think, like we said, being global and using a multi-asset class sort of perspective, I think is probably the way to go.
Yeah, no, I agree. Let's see. Question number 4. You hear that the ETFs are kind of basically the better mousetrap version of mutual funds, effectively. What is it that makes them so much better?
Well, a little bit of this is really kind of technology. If you think about the open-end mutual fund, it was designed, almost a century. We're almost looking at a century-old sort of vehicle.
Yeah.
And if you think about it from a technological perspective, opening the fund up once a day at the end of the day kind of made sense. Computationally, you really couldn't do it any other way. So to me, it's kind of an old technology. And so ETFs in that perspective are a bit of a better mousetrap in terms of A, transparency, B, tradability, and C, I think the biggest thing that people probably don't understand are some of the benefits from a tax perspective. At this time of year, anybody who's invested in open-end mutual fund is probably getting hit with a lot of, it's getting hit with capital gains distributions and things like that. And by and large, ETFs are at least able to help you defer those until when you actually sell the security. So from a tax perspective, I think they are a bit of a better mousetrap. And I think that, it's not for nothing that, just about every major asset manager is either getting into ETFs or is trying to get into the ETF space, because I think they recognize that it is kind of the wave of the future. All net asset flows in terms of funds have really all been going into ETFs and have been coming out of open-end funds for a number of years now.
As a follow-up, kind of the flip side of that, what about some dangers from ETFs? I've read, like Howard Marks mentioned before, about the ETF can never be as liquid as the underlying, basically. Anything going on there that has you a little nervous?
No, there's nothing. I mean, there's nothing magical that happens when you put a bunch of illiquid assets into an ETF. It doesn't magically turn those underlying assets more liquid. Perfect examples of that would be muni bonds. I mean, the vast majority of muni bonds don't trade on any single day. I mean, literally. So, there's nothing magical about an ETF. And so when we had our little market hiccup at, last year, and everybody was kind of up in arms about how, that it was the fault of, the poor pricing of ETFs during what was essentially a moment of kind of sheer panic,
Yeah.
I kind of took with a big grain of salt because if the underlying markets, and we're talking about the stock market in this case, if the underlying market is a mess, there's no reason to believe that the ETF is going to provide you any sort of protection or do anything more so than what you could get in the underlying securities, and especially when you have kind of data issues. I mean, that was clearly a
Yeah.
hiccup. And if you were trying to transact during that time period, there's a good chance that you had, that things were off one way or another. And so, I wouldn't really blame that on the structure itself. Like you said, the principle is the same. You can't really turn an illiquid asset into a liquid one just by kind of shuffling the deck, as it were. So I think that's a bit of a bad rap for ETFs, but I think, again, like any other, it's these structures are designed by humans, and as we go forward, they're going to get better over time. Hopefully, there are going to be other pitfalls and other mistakes that happen. So again, nothing's perfect. ETFs aren't perfect, but like you said, it's probably the better mousetrap at this point.
Yeah, and I think pretty good reminder for everybody back then, or last, what was it, August, to not have your stop losses in too tight there. Otherwise, you're likely to get taken out if it gaps down a lot at a huge loss.
Yeah, no, I think it has become, in a lot of ways, the markets have become, I've talked about this on the blog. The markets, it's never been a better time to be an individual investor. But that doesn't mean that things are perfect. And so, like you said, anybody who had stop losses in it, physically, on the exchange, were gonna, had a rude awakening that day. So.
Yeah. All right. So, question number 5. You have an interesting quote. I'm just going to read it. The primary role of the financial system is to coax risk-averse investors into risky securities. I thought that was a really interesting quote. What did you mean by it? And do you think it's even more of an issue right now in a zero interest rate policy environment that we find ourselves in?
Well, I don't think that it necessarily has anything to do with the interest rate environment. I think that's certainly a factor, and certainly has been one for almost going on the better part of a decade now.
Yeah.
But I think it's really more of a general point, and I think maybe there's a couple of examples. Let's say that you could earn 10% on a FDIC insured certificate of deposit today. Would anybody really own equities? Would we take the risk? Would we, especially, kind of given what's happened the last few days where the market has been particularly volatile, what would it take to get you into stocks? It would take a whole lot of energy and a whole lot of gumption to do that. And
Yeah.
so that's kind of one perspective. I think, the things that we've been talking about, mutual funds, ETFs, things like that, they're designed to help to help take specific risk and eliminate that and give you kind of market risk. And so I think from that perspective, that's what the financial system in an ideal sense is set to do. And so let's take another example, and let's talk mortgage securities. Obviously, things got completely haywire in the last decade during the run up to the housing boom and all of that. But the underlying principle is still the same. You take a bunch of mortgages, put them into a portfolio, you eliminate some of the specific risk, and you have a security that is, that has a more specific sort of risk and return sort of relationship. So I mean, I think the financial system is there for a reason, and I think it does help provide capital to businesses, and it help provides individuals a means of investing. Again, that there are a lot of ways in which that relationship can go wrong, and then, there's anybody who reads the financial press sees examples of private REITs and things like that, where salespeople have lured individual investors into sorts of securities that they really have no business in being, businesses being in. And that's where the system can really go wrong. But by and large, we do need kind of intermediaries to to aggregate, the capital from individuals and help us invest that into the market. And so, obviously you can do that on your own. You can do that in individual securities, but by and large, the vast majority of individuals really don't have the wherewithal or the skill to do that. And so that's why we have financial intermediaries. And I think one great thing about that is, again, what we've talked about, the indexing revolution and ETFs are driving those costs down. There are a number of different reasons for that, but the bottom line is that it's becoming really cheap and really easy for individuals to invest in, broad asset classes. And I think that's all to the good. And so, I think, we are buying, anybody who's read any of the behavioral finance or economics understands that we are, by and large, we're risk averse sorts of creatures. And so we don't like to lose money. And so it takes a little bit of movement, coaxing to get us to kind of come out of the cave and take our money out of the bank account and put it at risk. And so I think that's the role of in an ideal sense, that's the role of the financial system.
Yeah, I mean, it kind of you think about a lot of it is they're all tools, and so just like a scalpel can be used to hurt someone or also perform surgery, it really is all in the intention a lot of times, and the tool doesn't have to be good or bad.
No, that's absolutely right. And again, I think I have used that example in posts before talking about ETFs. They're really just a tool, and how you use them is a function of your own desires and your own strategy. And somebody who's day trading the SPY or the triple Qs is somebody very different than who's invested in a broad equity market index and is holding that for the long term. So again, the same tool used in two very different ways.
Exactly. So one of the questions we always ask, a bonus question about a book recommendation. What do you got for us today?
Well, one of your previous guests was Michael Mauboussin, and he has a book called The Success Equation. And I really, it's interesting because I've talked about this phenomenon before, where certain books kind of hit you at certain times in your life, and they can make more of an impact. And I think that's a book where if I would have read it 10 years ago or 20 years ago, I probably would have said, yeah, interesting idea, but it really doesn't have that much bearing on my particular life. But I think as you get older, I think you recognize that luck plays a very significant role in success, whether that be in the financial markets, whether that be in life, whether it be in business, sports, etc. And I think his book does a really good job of laying out in a very clear sort of sense and fashion how that process plays out. And recognizing, it especially affects you when you're kind of reading the media and you see kind of, every time you see a profile of somebody on the cover of Fortune who has done some great thing in business, you kind of taking a moment to say, what part of this is being in the right place at the right time, what amount of this is skill, what amount of this is luck, I think is a really interesting thing to frame the discussion. And I think that that book does a really good job of that. And I think one of the great things you do on this show is that we're talking about ideas. We're talking about ideas. And I think one of the downsides of kind of the financial books and maybe broader nonfiction books is that they can oftentimes become kind of a paint by numbers sort of idea. Somebody really wants to get across their process and they're going to write a book about it and go from A to Z. And that's really a lot less interesting, a lot less relevant than really thinking about some of these broader issues. And I think, bringing on people to talk about those sorts of things is really interesting and valuable. And I think that's where, like you said, long form content can really be interesting and helpful. And like you said, a lot of the stuff that get published isn't all that great. But when you do find something that's interesting and kind of changes your perspective, that's when you kind of sit up and take notice. And like you said, you recommend that book to other people.
Yeah, and I think there's always at least like one or two good nuggets that you can get out of a book, even if it's a couple analogies that help clarify in your mind how a process works. Maybe you thought you understood it, but now you just know a little more wrinkle of how it works. I've it's pretty rare that I've gotten to the end of a book and went, well, that was a complete waste of time.
Well, if the book's a complete waste of time, I don't get to the end of it. So,
Well, that's probably pretty smart. I've heard that I should probably be more judicious that way sometimes.
yeah, but I think this idea of when a book hits you, I think is really kind of important, and I think it's I think especially when you're recommending books to people, thinking about that sort of perspective, I think is kind of a caveat to kind of keep in mind, and I think that that's why I'm always somewhat reluctant when somebody asks me to give a recommendation of the top investment books. It really depends where you are, depends what you're interested in, and like you said, different books have an impact you in different ways and at different times.
Yeah, I find that really amazing too. That it seems like that book comes along right when you needed it.
Yeah.
But what are the odds that that's really true? I mean, and how many books that you've read maybe would have hit you much harder at a different time in your life and it would have been that book that you needed at that time.
Yeah.
And you're like, well, that one was okay, but if you would have read it at another time, you'd rave about it now.
Well, we're talking about luck. We were just talking about luck, and so in some of it is luck, and some of it is hopefully sussing out those good ideas and trying to find them when you need them. So
yeah. Well, Tadas, it's been great chatting with you, and thank you so much for coming on the show.
Thanks. I appreciate it.
All right, take care.